Okay, welcome to the Butterfly and Condor Workshop. This is the last class from a good friend of mine, Bruno. We've known each other a long time. We actually both lived in Cascais, Portugal at the same time. We used to have dinner and it was fun. But Bruno's been, he ran the Rhino Trade Alert Service and now he's trading for a family office in Barcelona, doing great and trading the Rhino and a little bit bigger size than most of us. So welcome, Bruno. It's great to have you on a meeting again. It's been a while.
Thanks, Tom. Yeah, it's been too long. Yeah.
Okay, and then before we get too far, just the normal disclosure that Aeromir is not a broker-dealer, investment advisor. It's for educational purposes only. Options, futures, bonds, currencies involve risk are not suitable for all investors. Past performance is not necessarily indicative of future results. If you want to read the whole thing, go to the bottom of any of the web pages at Aeromir and have at it. So with that out of the way, Bruno, I'll turn it over to you for the Rhino. And like I said, we'll keep it informal.
Yeah, I'm going to keep it informal because I actually worked on this presentation from previous ones. And of course, I can't expect everyone to have looked at my previous presentations over the last, 5, 6, maybe 8 years. But I will package a zip file with my previous presentations so that people can go back to them. And it's mostly going to be like an incremental update. And I have the previous presentations here, and I can go back to them if there are any questions. I don't see, now that I've shared my screen, I don't see the chat anymore, but anyway. I would like it to be more interactive and with questions. Of course, a lot of things are natural to me with regard to the Rhino, but for some of the audience, it's going to be maybe something new, something we want to explore. So anyway, so I just want to insist on the fact that it is just an update from previous presentations. So, and at the same time, I'm going to mention that I have a Slack group called Rhinos and Flies. Why did I call it that way? But because I think rhinos need to be versatile, and I have actually gone a little bit away from guidelines. And again, for those who have seen my previous presentations, I actually pointed out some flaws in the rhinos. The Rhino is actually a very good strategy. We've seen low volatility, high volatility, now back to, I would say, normal, regular volatility. And today it's a bit different. We have like a return of volatility. And all in all, if you can adapt to it, you're going to be doing well. So as an introduction, I have to, of course, say that I am not the original designer. It was Brian Larson, I would think about 10 years ago, who thought of a broken butterfly with an upside edge in the form of a horizontal spread, and more specifically a call calendar. There was then people, I remember Schwartz or Schwartzy, or I can't remember his name, Randy, his name was, who didn't like horizontal spreads, and he thought of a variation, I think even called it a white rhino, or maybe, where the upside edge was a cold broken butterfly. That can also work, and it can also make sense, knowing that generally when the market goes up, volatility goes down, and maybe you can get the same effect with a cold BWB. But I'm not going to go into that variant today. So let's go into a recap. And this is a topic I mentioned already last time, and last time was probably a couple of years, maybe 3 years ago, is that yes, we have seen a very changing market. I mean, COVID, I mean, in the end, we had a bullish market in higher volatility. So I would say besides the pandemic as such, it was pretty good for Rhino traders. My performance was okay, even though, and I will insist on that later on. I am a very conservative trader, and even more so now that I trade for a small family office. Technically, I work for a fintech that belongs to one of the brothers of family office, but doesn't change a thing. So we are going to look at how the strategy had to evolve. But at the same time, we will see that the prevailing principle is still the same. And it's still, and I will repeat that over and over, is still the flattest delta, lowest gamma over the last possible range. That's what I like about the Rhino when I first got to know it. As I said, about 10 years ago, it looked like it had a nice T+0, T+7, T+N projection line. And that's what I liked about it. And of course, by digging into it, I realized there are a few things that were not completely thought of at the time. So to recap, because of course I can't expect everyone to have the Rhino, to be familiar with the Rhino at all. Technically, it's the foundation is a broken butterfly, and in middle type of volatility, the upper longs will be near ATM. If I even go back to the original guidelines, the upper longs are slightly above the money so that you get enough theta. Because maybe I'm cheap and conservative, I've started looking at pulling back the broken butterflies, and we will get into that. Something I mentioned last time, and sorry if I get back to some reference of a previous presentation that you may have not looked into, but I realized at my own expense, actually, because I did not realize that as much as I had, as I should at the time, when the market went into, if you remember, 2018, the Bomageddon, when the volatility was so low, then when volatility kicked back, it was absolutely vicious. So I realized, and I mentioned that in some presentation, maybe 2-3 years ago, that you have to be flexible with wing sizes. I do, and that's my own bias in a way, that I trade larger amounts, larger number of tranches, and something I also mentioned in the previous presentation is that liquidity is higher in, can you see it here? Is higher around 25 and 50 point strikes. So I do trade essentially every 25 points. If you want to fine tune and craft your PCS to PDS ratio in your broken butterfly, of course, you can go to 5 point strikes or 10 point strikes. So this is a bit of a idiosyncrasy. Yes, I do trade mostly, or not mostly, every time I trade 25 point strikes. The good thing about the Rhino is that it's relatively low maintenance. You don't have to do much. You of course need to, if you have your trade on, generally, if you keep your delta flattish, you will just build into the position. You keep your delta flat, and well, I'm not saying this is not much to do, but at least whatever you have to do is generally not done in a moment of stress. And even like today, we've had the downgrading of the US debt last night. Market dipped like, we were towards 45.80 like yesterday. Now we're trading about 45.20, which in a way is only what, just over 1%. The problem is that volatility has spiked quite substantially. But yes, if you keep your delta flat, your gamma flat, you can still adjust, add, reduce in a fairly relaxed way. I mentioned here, sometimes you have to do the opposite of conventional wisdom. What I mean by that is that a lot of traders will think, okay, you know, vol spike, enter a new trade, add to the trade, yes. But sometimes if you think the market can go ballistic in a direction or the other, you may just have to do the opposite. Sometimes it's actually conservative and stressless to not add to the position, but just to reduce. Wait for the market to calm down. Volatility is generally sticky. Volatility will stay. So you can wait for the market to stabilize. You will still have an hour, maybe a day to then add back to the position. So you have to be nimble, and lots of people in the business world love the buzzword of being agile. Yes, you have to be agile, and sometimes it's better to maybe in a form of damage control, just to reduce and then reposition. That's not what I did today because my positions were pretty safe. So I just added to the trade. And I will show you a screenshot just now. And what is most important, and I think that's, if you trade a Rhino, that's something you need to keep in mind all the time. Keep your delta flat. I would even say keep your gamma flat over the largest possible range, so that you are covered in all. I mean, the market can, I mean, who knows, maybe the market will go back to 4,600 after Amazon, Apple post their earnings tomorrow. I don't know, nobody knows. So you have to deal with that kind of schizophrenia that, okay, the market can go down and maybe tomorrow is going to go sharply up. So in order not to be caught off guard, you have to, be ready over the largest possible range. Now, I'm going to talk about my own bias, idiosyncrasy, call it whatever you want it. I think it's actually a good thing, even for retail traders, people who trade their own account, to have this kind of metrics, which I would invite to adjust to their own risk profiles. The first thing is your margin to equity ratio. Of course, if you work on Reg T, your margin is fixed, but then you can still look at the minus 12%, and I'm specifically talking about indices, SPX, RUT, or NDX. I mean, generally, your PM margin will be calculated at levels of minus 12% and plus 10%. So you can easily, assuming that you have a good platform that does its calculation right, and I'm afraid one doesn't quite tally on that, but I mean it's still a good guideline. Check your either real PM margin or your estimated PM margin to your equity or liquidity. I have over the years figured out that if you trade a standard Rhino, you will never really get above, I mean, the Rhino is fairly conservative as it is. You will probably not trade over a 30% margin to equity or MTE. And that's why, this is the last item here, I actually use a limited leverage. So basically I calculate how much how many tranches I can trade for the capital I have. And I try to have a target MTE at about 35%. I would say 25 to 30 is good. Under 25, it's kind of low. So you're becoming a bit slack, you're becoming a bit too conservative. And I sometimes, because I'm busy, I mean, we all have a personal life and busy agenda. Sometimes my MTE is too low. And when I look at the market, I don't really feel like adding, adding to the trades and putting more capital at play. So sometimes I can stay at a margin to equity ratio that is too low. But you must always keep in mind that a 30 to 35% MTE is good. I've been trading on IB for a long time in South Africa and then in Europe. I don't know or remember how it works on TOS, but IB also has a volatility, let's call it a multiplier. So when you calculate your PM margin or virtual PM margin at minus 12%, and let's talk about the downside because today is a down day. I would recommend, because the PM calculation from IB is pretty much obscure. I've never figured out how it works exactly, but it does add a volatility element to it. So I would say if you have an estimated capital requirement at minus 12%, which is your, de facto your PM margin, I would add another 10% or round it up so that you can also account for the vol surcharge or surplus to your margin. Something I have learned over the years as a professional trader is also to use your margin over theta or theta ratio. It's not essential as such, but if you have margin and low theta, it means that basically if your margin over theta ratio is too high, your capital is not used very efficiently. So some of you, it has never been part of the guidelines. I can't even remember whether I mentioned that in my last presentation. Probably did, but maybe briefly. But the margin over theta will tell you, okay, I'm getting too slack. I can have all sorts of excuses for it. But I would say margin over theta, you should be under 200. 100 is great, meaning that your capital is very efficiently used. And if you go below 100, it means that you are maybe a little bit too aggressive for a Rhino trader. The other aspect is the equity or your liquidity over the Vega ratio. It's not essential as such, but because IB here in Europe has a volatility measure to the PM margin calculation, I would say that your equity over Vega will also give you some kind of guard against going too crazy about risk. I would say that equity over Vega ratio should be at least 100, maybe 200. But if you are again at 300, 400, 500, you're becoming too slack. You're letting go. You're busy somewhere else. Another thing that is more of a professional benchmark is a control VAR or value at risk. When you have a boss, and I can't say anything wrong about my boss, he's great. But when you work professionally and you have to stick to a mandate, and your mandate will tell you that, well, if you're, and for example, my VAR limits or my VAR action is set on 1 to maximum 1.5% on equity loss on a single day. If my equity goes down by 1.5% and I do nothing, I should be fired. I mean, really, it's like, well, you're sleeping on you being overconfident, you trust that the market will bounce back or whatever. No, that doesn't work that way. Volatility can be very sticky. A market can go down, and when you think the market will bounce back, no, it can actually go further down. So set yourself, if you're a retail trader, if you trade your own money, it's actually better for your own sanity and your sleep at night to give yourself a limit. If you lose more than 1% a day, do something about it. Do something. Risk control, damage control, but it can be, of course, more elusive, and it doesn't have to be cast in stone. Mine is 1.5% a day. If I don't do anything, someone will blow down my neck. Now, because the strategy itself is conservative, sometimes you want to push. I would say that if you trade a Rhino and Reg T, standard one leverage, you will probably get to 25 to 30% MTE or simulated MTE, MTE being margin to equity. I found over the years that by using a leverage of 1.2, sometimes 1.3, I managed to get more money per tranche on a cycle without adding much risk, because I'm still, the limited PM leverage of 1.2, 1.3 is accounted in the margin to equity, of course. So this is the ruling ratio is this one, margin to equity. If you think that after trading for a few months, 6 months, a year, that you don't get enough, but you get a fairly stable return, and of course, if you are on PM, that doesn't apply to everyone, but then you can add a little bit, like as I said, based on the Reg T, because again, that's something maybe I haven't mentioned, although I did mention in previous presentation. Unlike some, and I won't name them, who have designed strategies specifically for quote unquote PM optimization. Basically, you will get nothing, but if you trade on your PM margin, it will still look good. And then you have to leverage a lot to get the profit that you are looking for. No, my strategy, the Rhino strategy, even though I'm not PM, I still use a planned capital based on Reg T. I still use $38,000 per tranche. I have my capital, and I look at the number of tranches that I can afford, and then I add a little leverage to aim for the margin to equity, the MTE that I am comfortable with, basically 35%. That said, sometimes the market goes a little crazy. Don't cut everything off because you are all of a sudden, because of that volatility element in the PM margin, sometimes IB will just pump up your margin. You account for that. And even if my target is 35% MTE, I am not going to go crazy if it goes to 40, 45%. Again, when I said it was relatively low maintenance, the most important thing is that you have to give yourself time to react. So if my MTE goes to 40, 45%, I give myself a day, 2 days, 3 days to then reduce it. But I see that I'm on slide 5, I've got a few, and we are almost like half an hour. Okay, so a changing market environment. I like that adapt or die, because really in this market that goes a little crazy, that's quite important to adapt and not stick to guidelines. I've never been a fervent believer in cast in stone rules, especially that's where I actually departed from the original Rhino back in 2015, which was basically Delta rule. And I think it was a good catch for beginner traders. You just have to monitor your Delta and you'll be fine. No, that doesn't work. But so adapt or die, and you mentioned earlier that I was a mentor a few years back. And I don't think I was a good mentor, because I mean, students want to be mouth fed. They want to be told what to do in each and every environment. No, I mean, I'm always, and that's why I'm not very good with beginners who don't want to learn. I mean, you dive at the deep end and you learn to swim. And if you don't, and I will come back to that later, but a simple Delta rule doesn't work for all sorts of reasons. Okay, so what have we seen in the last 6 months, a year? We now into the post-COVID era, and what I've noticed, because that's part of the things I check every day, and I mentioned rhinos and flies earlier. On my rhinos and flies Slack group, I post this picks outlook, and I do calculate a few things, and I do check the correlation. Maybe that's in the morning. Yeah, I check the SPX VIX correlation. I check the correlation with the NDX, the DJI, the Dow Jones. I check a lot of things, and that's part of the homework, and I'll come back to that. And what I've seen lately is that sometimes the market is under-VIXed or over-VIXed. And I would say that a strategy that you assume or estimate will behave normally, all of a sudden, because your SPX VIX correlation is not what it should be, you have things that don't look right. And of course, they would appear if you have a platform that allows you to check your VANA, your VOMA, and I know I'm speaking quote unquote Greek to many, but yes, in layman terms, it's actually maybe easier to see whether your market is under-VIXed or over-VIXed. Basically, if the market is a little bit too complacent or overreacting to news. Maybe today is an over-VIX day. Who knows? I don't think we are at the bottom of this, but anyway. So what I've seen also in the last year or so is that the SPX moves crazily. Sometimes I haven't done the stats for this, but if you think that statistically a 2SD move should happen less than 1 or 2% of the time, I think the 1 or 2 SD moves have been pretty frequent, and sometimes you don't even know why. But yes, the large correlations and the fact that lots of banks, pension funds, when rates were super low and they still have to pay out pensions to retirees, and I could name, for example, the Swiss National Bank, who is one of the biggest shareholder in Apple. So, which means that in the institutional world, some of those large techs are seen as safe as bonds. So basically, the scene is changing, and you see that the techs are, I mean, the large techs, I don't know when Biden or whoever will look at the monopoly situation or whatever. I mean, but basically, those giants can make rain or shine. I mean, this is kind of crazy. But if we talk about something that is more specific to the last 24 hours, last night was different. It was a downgrading of the US debt. So those elements can happen anytime. They are random. And yes, I mean, everybody kind of, I mean, I've got a few friends who are fund managers and they kind of smile or laugh that with interest rates, the default rate would go up and the market, the economy is not as rosy as it looks. Yes, we have a picture that is given by the large techs, which, I mean, they are cash flush, they're doing absolutely fantastic. They're world companies. So even if the US economy goes down, they will still do pretty well. But we may have a debt crisis. So, and I will come back to that later. When the market goes up, you have to nurture, but also at the same time, control some kind of schizophrenia. In French, we say that the trees don't grow up to the sky. There must be some time a pullback. There must be some reason. So I am not a macroeconomics expert, even though I did an MBA in my youth, and so I can read a number of things, but I can't expect a retail trader to understand all of that. But there are good sources of information on the internet. But all in all, just be cautious. Just be cautious. Now, in the last 2 years, I would say that higher interest rates and higher VIX, it was pretty easy. And also, I mean, myself included, leaning towards some comfort zone that, you know, your trade will use less capital, pricing is great. And now that the market is going back to a more normal volatility, you have to adapt. So when the volatility regime changes, and I'm not going to go back to quant stuff, sticky delta, sticky strike, and this, but yeah, I mean, when the volatility changes, you have to adapt, and it can be 100% empirical based on experience, and you have to accept that as humans we are generally slow to change, slow to adapt, but we have to adapt. If you don't adapt, you're dead. So, and I must admit that I haven't had a fantastic performance so far this year, because I have been very cautious, sometimes overly cautious, but so at some point you have to accept, okay, the high vol regime is gone. When I mentioned that the SPX VIX goes sometimes crazy, and this is a daily chart. So this is the VIX, I use the Bollinger Bands, and sometimes you've got the SPX VIX that goes a little crazy, above zero. This is the average SPX VIX correlation. That's where you estimate that the market is, let's say, normal. When the market goes crazy like here, not so crazy, but not fantastic here, or in July, when the market went absolutely ballistic, there's something that has to give. In higher VIX, generally, like in maybe early 2023, we had a drop, and I could go back maybe 1 year or 2 years. I mean, these kind of events have been more frequent lately. And when something is not right, and now that we are in a lower volatility, we still had a fairly good volatility in a very up market. So that was actually a good time to do things and protect the upside. And I will show you some of my positions later. But this is a wake-up call. When volatility goes a little bit unnormal, you have to be careful. Of course, lately we had a change in interest rates. I wouldn't say, for those who monitor the Greeks, that it has had an impact on rho, which is basically the sensitivity to interest rates. But yes, interest rates have an impact on the economy, maybe not so much on the tech titans, which have, I mean, they are cash flush. I mean, they are doing absolutely fantastic. And something that I've started looking is that a weaker dollar generally is positive for SPX. So again, think out of the box, look at what could drive the market. We live in a global economy. If people get into dollar, when the dollar is cheaper, maybe people invest more into American equities. Now, something that, I mean, I had a kind of a eureka moment a few years back when I was, I mean, we're looking at so-called market neutral strategies, or I mean, some maybe better called delta neutral strategies. And I realized that there's no such thing as being market neutral. The original Rhino was completely ignorant of market reading. And I would say that if I save the day, is that is essentially because I have a pretty good way of reading the market. And I'm not going overboard with fancy stuff. This is my typical chart. I use standard support resistance levels. Here, the yellow line is a pivot. This is a strong support. And as you can see, bounces off there, bounces off there. And look where it's actually bumped. So, and those lines are known well in advance. So by having some kind of outlook, you can really save yourself a lot of sweat and stress. Personally, I don't use any moving averages. I don't use anything. I use support resistance levels and the common graphical patterns, ranges and pennants and whatever. Of course, sometimes those levels are not totally aligned across indices. And because we have a tech economy and we have the market moving because of Apple and Google, and especially now in the last year or so, 2 years, ChatGPT. I mean, basically, 20 years ago, 25 years ago, everybody was raving about the internet, and now today, everybody's raving about AI. So those companies who do control AI around the world are definitely the one to follow. So that's why I look at market movers, and I call them the tech titans. Actually, I'm not the one who looked at them, who is called them that way. And sometimes the levels are linked and correlated. The indices are highly correlated. I was showing on my last report, 92% with NDX, 94% with Dow Jones, but their levels may be different. So sometimes you think that it will stop on the level for SPX. If you are, like me, very observant of what's going on the text, you will also look at NDX or even a smaller synthetic fund based on what we used to call FANG, Facebook, Amazon, Netflix, blah, blah, blah. Now Facebook is now Meta, so I actually call them Gamma T. So that's Google, Amazon, Meta, Microsoft, Apple, and I'll put a slash because Tesla is a bit of the odd one out there, but it's still important. Another thing that is important, and of course I'm going beyond the Rhino itself, but reading the market is important for any strategy. And I am, of course, because I'm now a professional trader, I would say that you have to have a very strict routine. I do, of course, European time. I do that in the morning, European. It's about 2 a.m. Eastern, 1 a.m. sometimes. Today it was actually 11 p.m. because I got to the office at 5:20 this morning. I do the market outlook. I check a lot of things. And I do an update just before the market opens after news time. Something that I absolutely wanted to in the market reading, and I know it can be complex and complicated, but indices or even stocks, large stocks or all stocks, if you buy, I mean, you can't even fathom that when you buy some combo or some options, then that you have another trader selling you what's the counterpart. No, that doesn't work that way. We are in a dealer's market. So by knowing what the dealers and hedgers are doing, you have an insight about the market movements. And I will get to that just now, actually the next slide. So correlation I've already mentioned, sometimes unusual dynamics, yeah, okay. Anyway, you will have a copy of this PowerPoint. I have in the last 2 years coded my own Python script to calculate JEX, which means gamma exposure, and VEX, Vana exposure. I won't get too much into Vana, but let's say that dealers and hedgers, which are on the other side of your trade, have to balance their books. If people sell calls in a bullish market, it's a market for covered calls. People just bet their portfolio, their indices, or QQQ, SPY, whatever, and start selling calls. And if the market keeps going up, they buy their calls cheap or for nothing. So the dealers have to scramble to balance their books. So this is part of the, I can't remember exactly when I put this one on. I think that I probably did that over the weekend. And this should go. What we see here is that the dealers, when people sell calls, of course, the dealers have to sell them calls, and they become, they become, if they don't have as a dealer the portfolio to balance it out, they have to buy futures. So, and here my script calculates the amount of futures that dealers have to buy to balance their books. And that's the gamma, what I call that the gamma pressure. When gamma is high, it means that the dealers actually move the market more, a lot more than investors as such. So, and I would say, without going into the details, that, and I think that was on Friday, I think I finished this presentation over the weekend, and it showed that we had a very, we call that a wall, a very strong wall on 4600. On this JEX picture, we see that a very strong resistance, and this has nothing to do with technical analysis or even my support resistance algorithm. It shows that this is very important. It's going to be very, very difficult to move beyond that point. So I think at the time it was, I don't know, 45, 75, 4600. No, 46, maybe 4625. So and that's why, and I will show you my positions of the day, that I built that kind of conviction that the market would bump and bump and bump, but would probably not pass that level easily. And that's quite important also in building your hedges, that if you trust what the dealers are doing, you will probably place your upside hedge above that, and you should be doing okay. I just added a few things because of course calculations are as good as the data is, and it's not, we need option interest, and option interest is not something that is updated on a regular basis as of today. Another thing that has changed in the last year, 2 years, and Tom knows very much about it because he leads that zero DTE group with other traders, is that we have a huge zero DTE trading activity. I can't remember the exact calendar, but 5-10 years ago, we had the monthly expiration, the month-end expiration, and we had the Friday evening expiration. And then they started implementing Monday, Wednesday, Fridays, and now on SPX, there's an expiration every day. And since last year, the SPX options are trading 24/7. Exactly the way ES futures, what we call FOP, future options, which have been trading for many years. So the SPX has attracted a lot of volume. And on some days, like monthly expiration, OPEX, or, I mean, sometimes it's crazy. You think that by trading slowly over a month, 2 months, 3 months, no, I mean, everything is happening on a day-to-day basis. So people who think they can trade and they can maybe go away for a few days, look at the positions once in a while, maybe it works for you, great, but anything can happen within 2 days because the zero DTE has changed the scene enormously. What do I have here? Of course, again, and I have the same caveat, is that of course the option interest and all those things, and sometimes you have delayed data. This picture is volatile. I personally calculate my zero DTE activity 3 times in the morning, and then I leave it. So basically, when the market moves, I check where the zero DTE traders are positioned themselves, and I adjust if needed accordingly. Something that if you don't want to get into the mathematics of gamma and vana, okay, we can think of those walls as attractors. That means that when I posted or copy pasted this, the market was definitely aiming for 4,600. That's where the hedges were aiming, and that's what, I mean, $6 billion on a single day is important. I think it was on Monday, yeah. It's quite important. 5 billion on the 4,600 level is enormous. So just imagine that at the end of the day, this wall disappears. So what happened next? Well, you calculate the same picture for the next day. And then you can figure out, you build yourself a mental picture where the hedgers and dealers are positioning themselves. Okay, we are almost there now. So I'm going to look more specifically at the changes in the Rhino. Lower volatility means higher risk. I mean, again, I was saying earlier that we were in a comfort zone where high volatility, your theta comes quicker, your pricing is better. Now, if we, I mean, now at this point now, VIX is above 16, so it's on the I would say medium high. It's not 25 or like we've seen in 2022, but in lower volatility, trades will mature more slowly. So I would say that if you are in a lower volatility environment, protect your theta or theta. And also know that if you want to play on the call side, the IB skew will be flatter. So it's, as a conservative trader, when I was in a high volatility, we had a skew, and I think in my previous presentation, I must have put on a skew picture. Like, yeah, that was one. The skew forms quicker and higher volatility. In lower volatility, this will be flat and going, oops, and going flat all along. So if the safe side for a call side is around here. So if your skew is very flat, you don't actually know where to position your call side. So be careful. And I mean, I would say if volatility is low, try and avoid the call side. That said, I'm going to show on my positions because I have to make up for lackluster performance. Sometimes you have to be more aggressive, providing that your risk metrics, MTE, and so on and so forth are complied with. I would say if you have no conviction, use more conservative combos or broken butterfly. And as I said in the previous presentation, the entry in a medium volatility, and again, because I stick to 25-point strikes, would be 100 points on the PCS side, so the downside, and 75 on the PDS side or the upper side. If volatility goes low, let's say below 14, 13, you can go narrower. And if the volatility is high, you can actually expand. You can go to 125/100 or even higher. I mean, let's imagine that's, I don't know, in 2 years' time, the market is crazy down, and if you still want to trade, and that shows also the versatility of the Rhino or this type of strategy, you just have to go for higher wing sizes, and high wing sizes will, if you have a, I'm just projecting out of, I mean, from the top of my head, but if you have, let's say, 30 VIX, you could go 150/125, which means that your PCS to PDS ratio will be lower. And the lower PCS PDS ratio means more resilience on the downside. So high volatility, increase your wing sizes. Low volatility, allow yourself to go with narrower broken butterflies. This is a lesson from the last 5 to 10 years. And of course, if you are convinced the market will be bullish, I mean, go narrower, no problem with that. So what hasn't changed? I still use, as I said, vol-dependent broken butterfly wing sizes. I still enter around 70 if I've got capital available. Like, very fortunately, I closed my August trade early. I made capital available, so I entered October. I'm not sure I did right, but I entered October, I think earlier this week, about 80, 81. I mean, this is not cast in stone. You do, yeah. Most important is that you try and keep flat to marginally negative delta. And the flat gamma will also save the day in many, many occurrences. That said, the wing sizes can be flexible. If you have a good looking position and just want to add on because you have released capital from a previous cycle and you're ready to increase into the position, and you feel that, okay, I can go with a narrower broken butterfly, that's not a problem. And generally, if my add-ons are late in the trade, and that will be probably more of the case when the volatility is low, I don't mind starting with a larger wing size. And as I fine-tune my trade along its life, I can go with a 75/50, maybe later in the life of the trade. Excuse me. That's personal, but if you trade large amounts, you will have a better liquidity of under 25-point strikes. But I mean, that's personal. The Rhino guidelines won't make you good money when the market runs away. At best, it's going to be damage control. And I know a number of retail traders, or I mean, sometimes affluent traders, but not professional, who say, well, I save my butts, I'm not losing, that's good enough for me. Personally, I have to produce, and I try and produce every single month. So, but I would say that the decision tree in the original Rhino guidelines was not complete. There were cases, scenarios that were not fully thought of. This is a copy paste from an older presentation, and that's my guideline, and that was I don't know, 2-3 years ago, and it's still valid today. Since we are now almost an hour, so what has changed? What has changed? Because I am kind of restricted on my 25-point strikes, to get the look and feel I want, sometimes I do have to split my shorts. Sometimes I have to mix a broken butterfly with a balanced butterfly. And in this example, that's my September Rhino. I did what, a month ago, and as you can probably think for yourself, I mean, the market was going crazy. I mean, if you think that from the 10th of July until end of July, the market went from a low of 43.75 to 4,600, or can't remember exactly, but probably over 4,600. So about 5%. So what do you do? I mean, I can already show you, because I did a test of an entry on June 30th, and using the standard guidelines. I entered near the money. When the market started shooting up, I added to the position, and then what next? What do? Your market will run so fast that your delta will not build up to the point that you could action the call calendar. So will you just sit and wait for a pullback? Thankfully, you got your pullback today, but that may not happen. So, I mean, if you have nerves of steel, fantastic. Generally, that doesn't work well. So in this example, I chose to keep my delta flat and protect my upside. And when I saw, going back to VEX, you know, those pictures I showed you earlier, that 4,600 would be a wall that would be very difficult to pass. And still, I went very, very conservative, and I put not a call calendar, because a call calendar will provide you with a lot of positive delta. So what if you have already flattened your delta by going with the flow? You don't need an extra push in delta. So that's why I would say, think out of the box. Switch your call calendar with diagonals. Diagonals will not have that delta effect, but they will still protect you more. They will give you a little bit of Vega cushion, not as much as a calendar for sure, but they will give you a little bit of a cushion on the downside. I would say, like calendars, call calendars are not downside protection, but they will help you if the market retraces. But as long as you're in a bullish market, they will do okay. Diagonals will also do okay. And on top of that, if you choose your strikes carefully, you can even get your diagonals for a profit, for a credit, I mean. So I chose in this crazy bullish market to go with the flow. And when I saw that the 4,600 was kind of rock solid. I put on a diagonal. Again, I didn't need to flatten my delta. Delta doesn't go negative when the market goes crazy so fast. So again, you have to think a little bit differently and use your toolbox more efficiently. Another thing that has stood the test of time is I keep my delta vega ratio reasonable. That's not part of the Rhino. That's not part. I mean, and I even believe it is good for all sorts of broken butterfly strategy. If you want to, and again, that will only work if your SPX VIX dynamics will do work as expected. But VIX going down, volatility going down, the market going up, etc., etc. But generally, if you want to protect your upside, but not go outright Vega, delta positive, because delta positive, and Vega negative, if the market pulls back like crazy, it's a double whammy. So, but I would say that roughly 1% in cruising altitude, that's when your position is fully built up between 56 DTE and let's say 35, 28 DTE. You can use a 1% delta to Vega ratio. In lower volatility or later than in the life of the trade, I would say again, very conservatively, go for a 2% ratio. And if volatility is low and pullbacks can be vicious, nasty, you can maybe try and go for a higher ratio. So I showed you this one already. So when the guidelines fail, I would say combat your schizophrenia and don't think against the market. I mean, the market always wins. Go with the flow. And the jacks and gamma pressure will give you the market momentum. When I showed you earlier this kind of picture, it's a kind of a wall, but it's also, as I called here, an attractor. The punters will aim for that level. Sometimes it will fail. It's not an exact science. It could be plus minus 20 points, but they will go for it. So where was I? Yeah, go with the flow and use that market momentum that is given by gamma. Something I mentioned, for example, the delta vega ratio. I even say here, don't let your theta drop. I have been nursing some trades from people and say, well, I don't know what's going on, but yeah, their initial combo, like here, the market goes crazy, and the Vega goes at some point. Vega goes positive, so don't let your broken butterflies. Where is it? Turn Vega positive. That's not what it's meant to be. So be flexible with wing sizes, add on to the trade, keep your theta going. I would say my entry is complete when I get at least 10, 15 theta per tranche. And by the time I get to cruising altitude and I want my trade, and when I call cruising altitude is about 3 weeks after entry, so maybe 56 DTE, 49 DTE. I want my trade to at least get to 20 theta. If you are below that, I can go back to my risk metrics. It probably shows that you are being too conservative and you're not putting capital at work efficiently. When I say be flexible with wing sizes, when you enter a trade, for example, here, I chose 100 points on the PCS side, 75 on the PDS side. Later in the trade, if you want to do some fine tuning, you lost my screen. Okay, you can go. I mean, in this case, I went the same size, but because it's just a demo trade. But sometimes you can go. If you just want to fine tune, late in the trade, you can go narrower. for example, 75/50. This may look like advanced topics, so there are other ways to look at that. But of course, if you are, for example, traders who trade an A14 or trade I mean, short dated trade, you will look at charm. That's quite important, providing, of course, that your platform offers that. So be quite flexible with adjustments. I would say that if you know your game, there's only one rule: flat delta, low gamma over the largest possible range. Okay, I think I am almost done. And before yeah, I just want to show you my trades of the day. Because I mean, there's no better example than to show you. I mean, market is okay, what it is. And I mean, I can give you this presentation. Where is that? Okay. Because I've done my job. This is my reports. Okay, so this is my trade today. Let's start with September. This is my September trade. There was a screenshot on the presentation where I showed that I let the market run, and when 4,600 was in sight, I started putting a diagonal, no delta boost, but it helped me get some mitigation on the Vega, and look at where I am now. I don't know where the market is going today, tomorrow, but my delta is flat, my gamma is flat. I'm happy. I'm going to sleep very, very well tonight. The only possible problem is that, okay, let's look, we are 44 DTE, so this is supposed to be cruising altitude, and because I very often blame myself for not being 100% at it. Yes, my theta is a bit low, but of course, when the market shot up again, 43.75 to almost 46,600 in 3 weeks, the market is running away from your tens. Your theta will drop, no doubt. So this is minimal. So I'm not going to kick myself on that, but it's too low. And assuming the market would have behaved better, I should be at 20 theta. But because of what happened last night, I just adjusted today, and all I want is, I don't know where the market will be going tomorrow, but I've got a flat delta, I've got 0 Vega exposure, and okay, I need to work on my theta. But when you have delta and Vega, because we've had quite a nice bull spike today. When you have delta and Vega and a check, theta is a minor problem. It's not the major problem. Now, I mean, something I would mention, but because I still use Reg T, like Reg T is right here, as a benchmark, and I still use a number of tranches for my portfolio, but I still use a multiplier. What I trade could be traded by a retail trader. Because of the size of the fund I trade for, it's just a multiple amount, but this is still the same. Now, my October, okay, it's not great. I bet on the fact that the early resilience will save the day. So having a strong negative Vega initially is not too bad, but the market lost quite a bit, and well, I'm still flat. My delta is flat. I think today I added this diagonal, and I added another broken butterfly just to make use of that additional volatility, and for a change, have a combo at a reasonable price. Okay, so that's all I wanted to show. But I mean, you know, you can talk, you can teach, but it's always better if you act as per your own teaching. So this is what I wanted to show you. Something that I've mentioned many times is that there's not one Rhino. There's your Rhino, your MTE, your margin of a theta. I mean, basically your risk metrics will be different. That's what you get to know for yourself. I'm quite comfortable with the metrics I've chosen for my boss and of course for myself. And that, as I said, I'm not saying I sleep well, but I mean, generally by 12, by noon Eastern, I don't look at the market anymore. I mean, that's it. I've done my job. Anything can happen. I will only look at it next day. So you have to look at, do your market outlook, do your routine, do your homework, and then spend, I don't know, an hour to 2 hours a day. But once you are satisfied with your adjustments and the look of your position, that's it. I mean, there's no need to stress and wait for the close. I'm not going to, now it's the evening here in Spain. That's it. I mean, I'm not going to be worried about that. Another thing that keeps me busy, and I'm just using this as an aside, is that, yes, some of you may know me that I've been working on a first version of SOAP a few years ago, and it was really too complicated, not user-friendly. And I have rewritten completely from scratch a new application, and that's going to be a platform that will make me happy and hopefully make a number of users happy. There's definitely a gap in the market now that option view is out of the way, but I'm doing it for myself. And I'm not lying in saying that there's going to be a platform made by a professional trader for traders. It will have everything I need into it. So all the fancy Greeks, all sorts of features that I can't find in one. The support is, I don't know. I shouldn't be bad mouthing about them. I mean, but basically, they are so comfortable that they're not trying to really improve it. So I intend releasing SOAP 2 by the end of the year, maybe early next year. And check this out. There will be a free version. So I'm gonna definitely try and kick ass. And try and make sure that there's something even for the beginner trader. So yeah. Anyway, with Tom, we will organize something by maybe in the next month or so. I will show you a little demo.
Is SOAP 2, you said it's going to be kind of along the lines of option view, option net explorer type of look and feel?
I have a little problem here. I have unashamedly copied a lot of the one look and feel. So I have, at the back of my mind, I have some trouble thinking, if they look at my software, can they sue me? So I'll maybe have to do something about it. But yeah, it's one, but it's going to be with better stuff under the bonnet. Option view was great. It was just looking horrible. And one is looking great, but if you ever looked at their vol surface modeling in high volatility, it was awful. Now in medium volatility, the vol surface is looking better now, but when volatility was high, they didn't do anything about it. They didn't try and fix it. So anyway, I think we're getting close to an hour and a half, so maybe it would be good that we answer questions. I don't have access to the chat or.
I think you do, but if you put your mouse at the top of the screen, you probably will see it.
Are you trading SPX or futures? No, I trade SPX. Especially that now SPX is trading 24 hours a day and it's the same as ES. Yes. Where can you find out about Rhinos and Flag Slack group?
And do you have the invite link?
I have the invite link right in the last. So I will send this maybe, well, you know what? I'm going to send it to you, Tom, and you will post it.
Okay, can you make it a one with no expiration date?
Slack only gives me a 30-day. If you need an extension, the best is to send me an email.
Okay, I think Bruno at Aeromir still forwards to you, so that should be an easy one if people need to contact you.
Yeah, absolutely. Yeah.
All right, can you just paste that in the chat real quick, that link?
Oh, yes, of course, yes. And by the way, I'm not saying I am very well paid, but I'm paid well, and everything is free on my Slack. I'm not saying that besides the freeware version, the SOAP 2, the more fancy one, will be priced, I would say, competitively to one, but there will be a free version anyway. So, and there will be also a version for white labeling. So if Aeromir wants its own version of SOAP with Aeromir, I mean, that's not a problem.
Okay,
It's
looking
like-
forward to it, Bruno. It's always nice to have alternatives.
Yeah, I know it's only on IV. I will code the TOS TD Ameritrade interface, but I don't know why, since they've been bought out by Schwab, they do not accept any new API requests. I'd love to have a key to code the same data links for TOS, but I just can't. I mean, they keep on pushing it. Maybe early 2024, I'll be able to code it for TOS. But at this time, no way.
Well, thank you so
Okay.
much, Bruno.
No, it's my pleasure. I mean, it's been way too long.
Yeah, how's your Spanish coming along?
Let's say I get by the shop and restaurants, but at work, not only I'm not a very talkative person, I'm head down working, and I've hired a friend and colleague and assistant, and let's call it the bias is from South Africa.
Okay.
I am now hiring probably a guy from Spain in September. So maybe I will. But the thing is, Spanish or Castellano, as they call it here, is almost like a foreign language. I mean, if I want to blend in, I must learn Catalan. You know, Barcelona it's not Spain, it's Catalonia. Yeah.
Right.
It makes things a bit more complicated. Yeah. But life here is pretty good. I just wish I could enjoy it more.
Yeah. Well, we'll sit down and talk one of these days and catch up on parents and all that kind of kids and all that kind of stuff.
Absolutely. I'm sorry, I've been really too busy, but yeah.
And greetings from Gabby, by the way.
Oh, thank you. Say hi from me as well.
Okay.
We'll chat privately, maybe next weekend. Okay.
Sounds great. All right. Well, thank you again so much, Bruno. And
Thanks.
I'll get the link for people to join your Slack group. So that would be great. And if you like, I can always set up a forum that those messages never die. So
yeah, and I'm sorry if I went a little bit outside the specific Rhino topic, but I said at the very beginning, it's like an incremental presentation. I invite everyone who's interested to look, read, and I can package a zip file with my previous presentations. And this, I wanted to insist on what I have been using more in the last year or 2 years, in particular, the market reading capabilities of JEX and VEX and gamma pressure. I mean, those things are very important. And this is Python code. And again, I'm not selling it. If anyone is familiar with Python and wants my JEX code, no problem. I'll share it very happily.
Okay, appreciate it. All
Okay,
right, Bruno, take care and we'll talk soon, hopefully.
absolutely. Okay, thank you. Have a good
Thanks,
day.
everyone. Yep, bye.